Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm located in Oak Brook, Illinois. If you know where Oak Brook is, which obviously most people do, we're right across from the mall. So we look at almost restoration hardware. So 1415 West 22nd Street, Suite 530. So stop over. Don't need an appointment if you're willing to wait while we are most likely finishing up meetings or calls, Zooms, conference calls, etc. with our clients. But we'd love to meet with you. So Kuhn Capital Partners, as you know, our focus is to make sure that we are providing strategies that can have the ability to deliver in all markets. And we're going to talk an awful lot about that today. As you know, we do a lot of structured banknotes. And one thing I want to make sure that we talk about on the radio, obviously everything past performance related is past. So we can't really use that as an indicator of future performance. Anything we talk about on the tax side, we can't provide tax advice. We're not tax advisors. The tax advice that we provide, especially when we talk about the energy strategy or Roth conversions, is for informational purposes only, and it's obviously best practice to make sure that you're always reaching out to your tax professional before any investment decisions are made. So our job, and I believe that the bulk of advisors in that kind of who work with clients, now we work with clients that have, $250,000 to net worths of $50, $60, $70 million. So we don't have an account minimum, but what we have found is that those investors in the $1 to $15 million space, they're kind of, generally in no man's land. Really, it gets to kind of that $3 to $15 million space, because at $15 million, you're, kind of on the lower end of maybe a family office or a multiple family office offering, which we believe our offering is far superior, but that's just what we believe. But most of the individual investors that we work with, kind of in that $1 to $15 million of investable, they're just doing buy and hold traditional asset management, and they're utilizing very, very little protection strategies, hedging strategies. All of their assets are tied to the market going up or fixed income doing well. And as you know, we obviously do things significantly different at our firm. So I don't know you, you don't know me unless we've met. And so really just take the radio show as education. And if we talk about something that piques an interest, certainly we'd love to have you reach out, 630-492-1912, 630-492-1912. We've had a great start to the year. So, goodness, when you look at the assets and the clients that, new clients that have been hiring us, it's significant. And so we're very pleased with that. And I think I'm doing my job of education, because in this investment space, far too many advisors, I dare to say the bulk of advisors, in my opinion, are just doing buy and hold market-based strategies that work until they don't. And it's not debatable that the markets go up, because they always go up. But it's also not debatable that we have periods of significant market weakness and periods of prolonged market weakness. One thing that I haven't talked an awful lot about on the radio here recently is if you bought Microsoft in 2000, it took you 14 years to get back to even. Now, that was the height of the market, of course, right? And so you bought at the wrong time. But who's to say, we're not there now? And so we're going to talk a lot about the radio, not the radio. I'm doing the radio show. We're going to talk a lot about kind of the tax strategy, our hedge fund strategy, and obviously the banknotes and kind of what we're doing. So we are a financial planning based firm. If you work with us, you will have a financial plan. When we look at financial planning, it is so much more than just do you have enough income. Most individuals intuitively know that they have enough income to retire. We want to look at really stress testing that income. We want to look at your RMDs. We want to look at your tax situation when you have to start taking RMDs. We want to talk about strategies that you can reduce your taxable income, that can do Roth conversions, even though you think that you can't, because many advisors have probably told you that you can't if you make too much money. Well, what if you can combine that Roth conversion with a strategy that, greatly reduces your active or passive income with Bison 2, our energy strategy? And so those are the things that, we're going to talk about. And but financial planning is what you make of it. And so if you want a really basic financial plan, you can do that on your own. You can go to Fidelity, you can go to Schwab, you can go to Vanguard, you can do it online. And, those are, what we believe to be very, very basic financial plans. Not that they're bad, they're just, very basic. And it really depends upon what you're trying to get out of that financial plan. So when we look at individuals who have IRAs that, are multiple seven figures or even just seven-figure IRAs, the tax liability that you're going to have is going to be significant when the government tells you that you have to start taking RMDs. And we want to start planning for that now. It's never too late to plan. And so those are the things that we're doing. 630-492-1912, 630-492-1912. But, thank you to everybody who's, reaches out. And we just love having, conversations with investors. And we like people that look at the world a little differently. We like people that are tired of hearing, just sit and wait if the markets go down, or, your portfolio does really well when the markets go up, and then it just sells off and goes down when the markets go down. And if that's the type of strategy that you want that simply tracks the market, you can do that on your own. And we encourage you to do that. We encourage you, if that is what you want, to go to Charles Schwab, albeit Charles Schwab is our custodian, one of our main custodians, where we have our clients' money at. Or you can go to Fidelity, you can go to Vanguard, and those firms are going to do a great job. And if you want to, just simply track the market up and down. And that is a very dangerous game to play, especially at these valuations. At these valuations, historically, I don't have the study in front of me, but I believe it's 100% of the time, 10 years later, at these valuations, the annualized 10-year number is between -2 and +2%. Now, that was a study that I read. But we can get it for you. And so you have to look at where the markets are today. And I think that's why so many people reach out to us, is because of the banknotes. And we talk a lot about the banknotes, the structured banknotes. They're so simplistic, in my opinion. Now, we do them every day. And, maybe they were cutting edge in the early 2000s. Certainly not cutting edge today, but it shocks me to know, or to just, talk with investors that their advisors have never even had the conversation of what they are. Because that's our job. Our job is to have conversations of what strategies are out there to make sure that you can make the most amount of money with the least amount of risk and volatility. I mean, at the end of the day, I think that's the job of an advisor. And it's the job of an advisor to articulate and educate, what, strategies that are out there. And when you look at the banknotes, I mean, these are so in my opinion, so simplistic. Now, they're a prospectus item. So we encourage you that if you want to, or if you've considered, calling in for the banknotes, just call in and get the latest banknote that we did and read the prospectus. Because for all intents and purposes, the prospectus is, if it's a different issuer, a different bank, let's say from JP Morgan to Bank of America to Goldman Sachs, I mean, they're going to be a little bit different. But if it's the same issuer that we do, it's going to be very, very similar. And so I encourage you to read the prospectus. And when you can look at an investor, when the traditional advisor is still using fixed income as the only means of portfolio mitigation, portfolio risk management, downside protection, and you look at what fixed income has done over the last 5 to 6 years, I mean, I still think we're in the largest drawdown in history in the fixed income market. And you can Google a 10-year, you just Google, the Barclays Ag and look at what that performance has been over the last 10 years. I haven't looked at it in the last couple of weeks, but last time I looked at it, you were, getting under 2% annualized for a 10-year period. And that's challenging. That's challenging, especially if we're going into who knows what's going on with inflation. But maybe they say it's coming down. I don't know about you, but my cost of living certainly isn't coming down. But when you can look at a client and say, here's a strategy that's offered by the largest banks in the world, JP Morgan, Citigroup, Bank of America, Morgan Stanley, UBS, Goldman, et cetera, that is going to provide generally double digits as long as the index that note tracks is not down 30%. So let's say it's a Goldman note that pays 12% annually, and it follows the S&P, the Russell, and the KRE, the Regional Bank Index. And as long as those indexes each month on the monthly observation date are not down 30%. Now, again, it just has to be one of them that's down, but as long as all of them are not down 30% or more, then you get paid your 1% in this example. And so those types of strategies are incredibly, incredibly popular for individuals that want to maximize cash flow, that are tired of just listening to the 4% rule or 4.3% rule, or want a hedge in the equity markets. And so, again, they're a prospectus item. And so everything that I say on the radio, you can verify. Just get the prospectus, call us 630-492-1912 and read it. Read a past one so you have a good idea if you really want to take advantage of these. And so, we're doing a lot of those. We're doing a lot more on the educational side as far as videos. We think it's so important for individuals to just, educate themselves at their leisure. And if we do anything well, we believe it's transparency. We believe good, we believe bad, we believe the ugly. Everything should be had, a conversation should be had with individual investors. And then when you can craft a portfolio that ultimately can include strategies that can greatly reduce your taxable income, strategies that can deliver a positive return in negative markets. Now, I say negative markets, these types of strategies, as long as the indexes aren't down 30%, that's what I'm talking about. So if the indexes are down more than 30%, then obviously you don't get paid your coupon payment on that month. And then, strategies that have the flexibility, like our hedge fund, Bison Alpha, that can really take advantage of volatility in the market. And, that strategy we launched fourth quarter of last year, end of third quarter, beginning of fourth quarter. I can't remember exactly, but we look at the performance and we're very, very pleased with the performance. Now, again, past performance is not indicative of future results. Heck, it's only been 4, 5, 6 months. So I would never invest in any investment, on that type of performance time period. But you have to make sure that you're giving yourself flexibility. So 630-492-1912. More after the break.
Are you close to or already in retirement and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC registered investment advisory firm and fiduciary, headquartered in Oak Brook, Illinois, right across from the mall. 630-492-1912, 630-492-1912. Listening to a podcast on sports. I love sports. And it was really interesting. They got into business, and they were talking about what's really the first thing that you do when you start a business. And it is really simply, you have to identify exactly what it is that you do and you do differently. And it really kind of hit home to me, because I don't know if we've done that. I don't know if we've done a good enough job of articulating just how different we are in our minds. And now, I guess almost 30 years now of investment experience. And so, I spent a lot of time in my career working with other advisors. And so I have a really good understanding generally of what other advisors are doing. And we meet with a tremendous amount of potential investors. And so obviously, they will ultimately share with us what they're doing. And we just see it over and over and over again. And so when I was listening to this podcast, and it said you have to have a very clear 30-second elevator pitch. And, I don't think we've done that. And now on the radio, I think we do bits and pieces. When you come into the office, I think we do. We at least hope that you can see it. But when you're in an industry like we are, and you're in an industry that's not something we live and breathe, or you live and breathe and eat every day like we do on the finance side, we all can kind of get lumped into the same type of, all advisors are the same. And that couldn't be further from the truth. And when we look at, what Kuhn Capital Partners is, and when you look at why we, are what we are and what gets us up every morning to go and do what we do, it's really to try to be different. And everybody can say they're trying to be different. Everybody can say that, they have strategies that, can manage the down markets, that can, do well when the markets, aren't doing well, or, but they don't. And when we look at portfolios and we see it, people look at diversification, and that's an old buzzword, obviously, diversification. And that's just making sure we have a car in every lane, so that in theory, you have something that does well in all markets. So if this is down, this is up, well, hopefully we're hovering around that flat line, right? But diversification to you is the number of investments that you own. And I don't think that's really diversification. I don't think that's how you look at diversification, because you may own 100 stocks, but they're all equities, right? So you're going to be, now they may have, higher correlations, lower correlations to the S&P, but at the end of the day, they're all equities, and they're going to move, kind of in tandem with what goes on in the equity markets. And then you have fixed income. So don't look at the number of investments that you have as a way to determine if you are diversified. And when we look at diversification, again, you look at the bank notes, right? The structured bank notes. I mean, those offered by the largest banks in the world, currently paying, double-digit distributions, doesn't mean they're for everybody. I mean, there are ways to lose money in those types of strategies. Now, if you lose money in that type of strategy, it's probably, you look at your other assets. I mean, those are goodness. I can't imagine what those are doing, because I don't want to say it really is it's a strategy or a market environment that just doesn't happen very often. But you look at the bank notes, and you look at if you can buy an investment that's backed by the bank. It's the bank strategy. It's the bank investment, Goldman, JP, Citi, Bank America, BMO, et cetera. And you're still getting double digits with 30% downside protection before you don't get paid a monthly coupon. Well, guess what? That's probably something we want to have a conversation about to see if it fits ultimately what it is that you're trying to accomplish. And then you look at, on the other side of our investment kind of offering, is our energy fund. And you look at, especially here in the Midwest, there's very, very few advisors that focus at all on the energy space. And if they do, it is equities, and which is great. I mean, that's good. We are the general partners. It is our fund of the Bison 2. It's an energy strategy that, again, at first glance may seem complex, but when you are educated in really 5 minutes, it's pretty simple. What we're doing, we're just simply taking ownerships in the majors projects in the best oil field in the world, out in the Permian Basin in West Texas, certainly here in the United States, arguably the world, I think the world, but, if not number one in the world, it's 1A, but it can't be debated. It's the best oil field here in the United States, where the bulk of capital from the majors is invested in. And we have created a fund that has significant diversification of operators, significant diversification of wells, significant diversification of geographical locations. And the tax benefits are significant. And so we always target 80 to 85%. So if you put in 100,000, you get a tax benefit that can reduce your active or passive income by 80,000 to 85,000, whatever that is. Certainly could be more, certainly could be less. We don't make investment decisions simply on the tax side, but they're meaningful, and it's active or passive. It's 1099, it's W-2 income. And so we have a lot of investors that are, higher net worth investors. Now, for that strategy, you need a minimum net worth, not including your house, of $1 million. That's not our requirement. It's the SEC's requirement. That's the accreditation to be an accredited investor. So you have to meet that criteria. But if you sold a business, sold a property, sold a home, if you're a high wage earner, if you have significant concentrated stock positions that you want to start diversifying out of, but you don't want to get hit, or you want to minimize the capital gains, again, these are the things that we can do that others just aren't doing. And again, taxes, it's for educational purposes only. Bring your tax professional involved into the loop with us, and let's talk about this, and let's make sure that they see it as we see it. Now, again, very black and white, but we cannot provide tax advice. So, but when you can utilize that type of a strategy that is cash flow based, but also focuses on total return at exit, and it's only, a targeted 3 to 5 year exit. I always say 5 years. It could be, 2 years, could be 3 years, could be 4 years. But if that can make up 10, 15% of a portfolio, well, again, we just talked about the bank notes, a way to make money with 30% downside before you don't get paid a coupon. Then we talk about the energy strategy in Bison 2, and that is a pure education story. So 630-492-1912, 630-492-1912. We want to make sure that you have a very good understanding of that, and we've created, or in the process of creating, and I've been saying that for a long time, but I am one of those types that I want something perfect before we roll it out. But we have, or are working on completing an educational series of videos just to kind of explain what it is, what it's not. And those are offered always by the private placement memorandum. And so that has all the risks, all the really, it's look at it as kind of the prospectus of a private investment. But we just gave you two strategies that have the ability to make money even if the markets go down. And that is, what our job is as advisors. Many people don't work with us where they come in on the first day and they say, okay, boom, we're done, and we're going to hire you, and that's it. We really don't want that, candidly. We want it to be a couple meeting, 3-4 meeting process, because that is something we put a lot of work in on the front end to make sure that we go over every single one of these strategies. Again, in my mind, they're very basic, but I've been doing this 30 years. They may not be so basic to you, but we believe in education, and we believe that when we can articulate what they are and what they're not, and we don't have a vested interest in selling you, we have a vested interest in educating you, then you can decide if it works for you. And so, we have, generally the, it's a financial plan meeting, and then we have the investment meeting, then we have the allocation meeting, then we have the implementation meeting. And so people that come in, they're immediately disarmed, because whether you become a client or not, I don't want to say it's irrelevant, because we like to grow our business. We like to help a lot of people. But we have a very established business already. We have a very established clientele already. And so we're not worried about bringing in additional clients to pay the bills. And so that can give us a level of comfort that we're not just going to tell you more of the same, because if you want more of the same and you want something that just tracks the market up and down, do it on your own. Go and meet with the Fidelity advisor, go and meet with the Schwab advisor, do it virtually with Vanguard, and hope that we're in a good period of the market, because so many of these people today that are selling, like we often talk about the lifetime income annuities, and I'm going to get on kind of my soapbox here in a minute about the annuity space. And again, when we do the annuities, that's outside of our fiduciary asset management role, but it is all through us, because we all are also insurance licensed. But you have to know that it's not on the advisory side, but it is on the insurance side. And those strategies pay us a commission. Personally, I would rather it not pay us a commission. I would much rather it pay us an annual fee. But how I'm paid is irrelevant to making a suggestion or sharing or not sharing an investment strategy with you. but more and more that I'm seeing with the larger RIAs is that they don't want that commission either, so they don't even share with you the annuity strategy. And then you have on the other side the guys that do, it's always a good, I think a best practice to ask the advisory firm that you're working with that they're recommending what percentage of your clients or what percentage of your total book of clients does this strategy or this type of a strategy make up. Because if somebody's doing 80% annuities, well, newsflash, they're selling you an annuity no matter what. And we're going to roll this, topic into the next segment. So, we're coming up against a break here, but I certainly want you to, stick with us here. But when you look at the lifetime income annuities, I'm very, very concerned of the lack of education that is being done from those quote unquote advisors, insurance agents, et cetera. They're showing you back tested hypothetical performance on the illustrations, which I think, and my belief is that that's wrong. The industry allows it though. And so you see these ridiculous 10-year numbers that I would personally invest in, because if you have no risk to the downside other than, the investment's backed by the insurance company. So it's not FDIC insured, of course, or backed by the government. But if they are showing you these numbers, it's no wonder so many people are investing in these. But here's the reality and the newsflash. The actual performance, and that's something that we will clearly share with you, the actual performance is significantly different. I see more and more people that they buy these annuities and they just don't grow. So we're going to finish this conversation after the break. 630-492-1912, 630-492-1912.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Coon Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Coon at 630-429-1912 and visit our website, cooncp.com.
You're listening to Destination Retirement with Robert Coon. Still to come on today's show.
That's what we believe in, is articulating strategies that we personally would invest in, that we personally as advisors that can look at this whole huge field of different investment choices and that we bring to the table for our own money. And I think it's a little different. I know it's different. And most advisors, are packaging these products, these strategies as proprietary, as unique, as this, as that. But at the end of the day, it really is a closet index fund, meaning it just tracks the market up, tracks the market down. And if that's what you want, I have to question why you would pay an advisor.
That and more still to come on Destination Retirement with Robert Coon. Wake up, brush your teeth, get dressed, get the kids out the door, drive to the office, and realize you don't even know how you got there. Seems like while we're working, we're operating on autopilot. And while that might be okay when it comes to the 9-to-5, autopilot won't cut it for your portfolio. Your portfolio needs to pay you, continue to grow, and be as tax and fee efficient as possible. And that's where Robert Coon and Coon Capital Partners can help you. Meeting with Robert and his team at Coon Capital Partners is a good start to living the retirement you want to live. To set up a visit and get on the calendar with Robert Coon, call 630-492-1912. That's 630-492-1912 and talk with Robert about the things you've heard on today's show. You can also find out more about what Coon Capital Partners can do to help you with your retirement online at cooncp.com. That's KUHNCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Coon, president and founder of Coon Capital Partners, independent registered investment advisory firm and fiduciary, headquartered in Oak Brook, right across from the mall, 1415 West 22nd Street, Suite 530. Doesn't matter which elevator you're going, you're going to get off the elevator and turn left, and you're going to walk right into our office. So no appointment needed. Come on in, but just know that you may need to wait, because good chances are we're in a meeting with a client or a potential client, or on a conference call, but grab coffee, take a look at all of our framed jerseys in the office, and we'll certainly meet with you as quick as we can. So talking, obviously, I like to go over the banknotes because that's what interests so many people. Still pricing double digits. I think the last one we did was 12.3, 12.4, somewhere in that area. Backed by, again, all of these we're only using what we consider to be tier one banks: JP, Citi, Bank of America, Morgan, Goldman Stanley, UBS, BNP, Bank of Canada. I mean, it's just, the list is, you're going to know these banks. And if you don't, you're going to see just how big they are once you just do a quick Google search. And so 30% downside, that's generally what we're always going to use for all of our notes. So that's pretty much the consistent. We'll use the same indexes. We have two tiers of notes, but we use the same indexes for both tiers. Excuse me. So the S&P, the Russell, and the KRE, which is the regional bank index for tier one, tier two. Generally, it's the S&P, Russell, and Dow. Different rates, and there's reasons why we have two tiers. But tier one is still pricing, mid 12s, at least as of a week ago. With 30% downside. Generally, we don't deviate from that. So 30% downside, as long as those indexes aren't down 30% on the monthly valuation of when they look at them from the date it was purchased and issued, then you're getting your coupon payment. So whatever that is. So if it's a 12% note, you're getting 1%. So yes, the indexes could be down 25%, and you're still going to get that 1%. So still pricing really strong. So 630-492-1912, 630-492-1912. Reach out, have that conversation, and we would love to go over that in greater detail. And if you're looking at them, these are a prospectus item. So the bank actually has to create and file a prospectus. So if you'd like to read that, you like to read a past prospectus just to get an idea, a fact sheet, etc., 630-492-1912. Because where the markets are today, that could be a real savior to many, many portfolios, especially, at these valuations. And, we look at the valuations in the market and, at historically speaking, 10-year forward number at these valuations has, I think always, again, I talked about this in the first segment. I have to look back if they use that always word, but -2 to +2 annualized growth. And so that's one consistent that we seem to think. Now, that again, that doesn't mean just because it's always been that it can't be much greater or much lower. I mean, that's the thing about the markets. History, as they always, tell us that, compliance, that we have to, anytime we talk performance, that it's past performance. It's not indicative of future results. But, when we can, if we're in a low growth environment, those banknote strategies, especially for those that want to clip cash flow and create cash flow, they can be such an important part of the portfolio. And 9 out of 10 advisors is my belief that have no idea of what they are, which is sad, but it is what it is. So 630-492-1912. So talking about the lifetime income, and the problem with those illustrations that the insurance companies show you is that they're allowed to use hypothetical back-tested data. And so we've seen just crazy 10-year numbers and just crazy income numbers. But after you own it for a year, 2 or 3, you see that, it's just not doing anything. And the index, what they showed you it did, it has done nothing close to that. And so if you own one, if you're being sold one, we can actually take the illustration and we can show you what the real performance is, because there are sites that you probably don't have access to, but we do, that can actually show you the performance, and you can see just how dramatic the difference is in most cases. And it's unfortunate, but again, remember those lifetime income annuities. It's a fixed payment. They put a governor on how much you can take out, and if you believe in inflation, what's $1 worth today versus $1 in 10 years, and albeit it may provide you lifetime income, and that is what gets many, many people. Remember that you're only taking your own money out of that investment until the account goes to zero. And it's my belief that actuarially the insurance companies know they're going to give you just enough growth, and they're going to put a governor on how much you can withdraw so that account's not going to zero. So a lot of people are calling us and figuring or asking us, can we get out? And the problem with getting out with those is their surrender charges. So it really becomes a math equation and of how much are you willing to lose. and then hopefully have made up in another investment before you, or if you want to make a change. And we can show you that. We can, Excel spreadsheet that, because if we hesitate to put it in the equity markets because, the equity markets, there is so much uncertainty, especially at these levels. So we'll generally look at the bank notes. And if we have a note that's paying 12% with 30% downside, we can just do some factoring of, it may take you a year, it may take you 6 months, it may take you 2 years to get back to even. And then, hopefully you're getting that growth as long as those indexes, don't go down 30%. But we can even run it where if we miss 2 a year, what that math would look like. So those are things that we're doing for investors. And I know so many people on the radio sell those annuities, and that they wrap them into, they wrap themselves up into a, financial planning firm. But again, 80% of their business, 70% of their business is, selling the annuities. So darn well that, well, at least in my opinion, you would need to question that objectivity of the advice that you're getting. So 630-492-1912. We'd love to help you see if we can do the math and see what would be required for you to get out of those annuities if it's not growing and you're not happy with it. That doesn't mean we don't like annuities. That's, the challenge. And most people tag us as kind of, people that don't like annuities. One of the greatest strategies that I think we have in our protected growth bucket is a 5-year index annuity, 5 or 6. There are many options, but generally we'll stick with the shorter term ones. But what makes this one different is that we will generally, not always, but generally, will always tie it to the S&P 500. And so there's a cap on the upside and there's a floor on the downside. And so the floor on the downside is 0. So if the S&P is down, 20%, your return for that year is 0. Now, these strategies don't include the dividends, and so you have to factor that in. It's not perfect, but there's a lot of people out there right now that where the markets are, or they want to use it as a bond replacement or an equity hedge. The current cap that we've seen on the strategies that we utilize, the companies that we think are strong financially, et cetera, is around 10.5%. And so you get the first 10.5% of whatever the S&P 500 does, not including the dividends. And then if the market is up any more than that, then you don't get any more of the upside than whatever that cap is. But that's a pretty darn good strategy for some people if you're happy with those types of returns. Maybe use it as a fixed income alternative. Maybe you're getting ready to retire. Maybe you have money that is earmarked for something in the future, but you don't want to have equity exposure, but CD rates are not what you like them to be. This is a really good strategy. And when you get a gain, that gain's locked in. And so it never goes back down. Now, those do pay us a commission. And so that is on our, insurance side of the business. But again, how we are paid, I don't think should be reflective of the advice that, we provide. But again, it's important for you to know that. So we look at it and we look at, the strategies that we're bringing to the table, the strategies that if inflation is going to continue, to potentially, go higher and the markets are going to have below average growth. And there is kind of a dynamic, a big shift, in our opinion, going on away from the Mag 7. And so many people, I can't tell you how many people I know that many that are clients of ours that, just have ridiculous gains in the Mag 7, 1,000% type gains. I mean, just crazy gains in the Mag 7, and they don't want to make any changes because of the tax liability. And that's a really dangerous game to play. And to me, I'm okay with paying taxes. I'd rather pay taxes than lose money. But when you have a strategy like Bison 2, the energy strategy that can help mitigate, some of those capital gains, in the energy space, that's a strategy that we probably should talk about. But also the hedge fund, Bison Alpha. And so the requirements for Bison Alpha are $2.1 million net worth, not including your primary residence, or $1 million with us. And so if you meet those criteria, you can invest in Bison Alpha. And it's a hedge fund that, again, we run. So it's our fund. But really it's built upon our investment philosophy for our personal assets. And how would we invest in what we like to do? And it's really a go-anywhere strategy. It's a maximum flexibility strategy. We look for inflection investing. We look for companies that are going through some sort of issues, whether they're, issues generally mean bad. Issues can mean good if you're growing too fast, right? But there's some inflection point that we believe is ultimately going to happen. And just utilizing, AI and utilizing, the software that we utilize for the fund, it helps us make sure that we're not missing any, it kind of sees around the corner. It kind of checks our blind spots. It doesn't tell us what to invest in, but it stress tests kind of our theory and our thought process. And the beautiful thing with AI, and really not just AI, but technology, is you don't need to be a 100-man shop to manage significant assets. And, generally what you see is the hedge fund managers that do really well are smaller funds because they're not doing it at a massive scale, so they can invest in more items. And so that's a strategy that we really want to talk about more with individual investors. And again, it doesn't mean you put 100% of your money in, maybe 15, maybe 20%, maybe 5%, maybe none. But we want out. We want outs. And when we talk about wanting outs, what I'm talking about is we want outs that if the market's down, that we still have something that can deliver. And that to me is, how money should be managed, because very few advisors, I don't know if I know any, I'm sure I do, but I don't know any off the top of my head, that just buy and hold, but yet they do it for their clients. So makes you question, what's going on. 630-492-1912, 630-492-1912. More after the break.
Are you close to or already in retirement, and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm, SEC registered investment advisory firm. Doesn't mean we're good. Doesn't mean we are, just because we're SEC registered. It's just you meet the criteria of managing more than $100 million. But we are fiduciary. We believe that in transparency. We believe in financial planning. We believe in tax reduction. We believe in modeling out your RMDs, where most advisors won't show you that. We believe in modeling out those RMDs to age 95 and trying to talk about Roth conversions, where most people have been told you can't do that. And maybe that advice is good if they don't have a strategy that, like Bison 2, our energy strategy, that can reduce your taxable income at a targeted, for every $100,000 invested, 80 to 85,000, and that's against active or passive income, any income, capital gains, doesn't matter. Now, again, not tax professionals. We always encourage you, best practice, reach out to your tax professional, of course. You can do the research, just Google, ChatGPT, whatever your favorite AI engine is, the benefits of investing in oil and gas. And so we created that fund that is very diversified in our opinion. It's close to private equity as you're going to get without having to write a $5 million check, because our minimum is only $100,000. But that's what we believe in, is articulating strategies that we personally would invest in, that we personally as advisors that can look at this whole huge field of different investment choices and that we bring to the table for our own money. And I think it's a little different. I know it's different. And most advisors, are packaging these products, these strategies as proprietary, as unique, as this, as that. But at the end of the day, it really is a closet index fund, meaning it just tracks the market up, tracks the market down. And if that's what you want, I have to question why you would pay an advisor. Why would you pay the advisor their 1.5%, 2%, whatever that percentage is? Because that does add up over time. if you're not getting any value. And so if you want to just buy and hold and hope that, it's different this time where the valuations of the markets are, we look at the forward 10-year number and it could just be significantly disappointing to what it's been historically, at least the last 10 years. I don't think that you should work with an advisor if you want to do that buy and hold strategy. I think there's plenty of places that you can go that we're going to give you quarterly meetings and diversify your assets. But again, when we look at diversification, generally those companies are going to diversify amongst stocks and bonds, and they're not going to diversify against, the banknotes that are, still paying double digits, as long as, those indexes aren't down 30%. Again, past performance, not indicative of future results always. But the banknotes are still pricing 12.5%, at least they were last week. And, you get 30% buffer of the indexes that note tracks each month. Well, it's from issue, but they look at it each month. And as long as none of those indexes are down 30%, you're paid. So if we're in a low environment, think about that, 12.5%. That's significant. We did one last year, JP Morgan, around April or May, and it was 15%, 15.5% actually. Now, again, it was during that volatile period. I wish they were, pricing at those rates today, but unfortunately they're not. But man, I wish I would have locked in that for a year or two, even just, it would have hit the yield if we locked it in for, longer than what we do, 6 months, as far as the minimum non-call. So you're going to own it for 6 months, but heck, still 13% would have been great, but you live and learn. So, when we look at, what investors need to do today, you have to, in our opinion, you have to have more. You have to have more institutional strategies and more strategies that have some sort of a defined outcome. I look at the banknotes as defined, meaning, before you invest what the outcomes could be, whether positive or negative. That is a phenomenal strategy. And when we look at strategies that have that 30% buffer on the downside and you're still getting paid your coupons, that's a pretty strong investment. And that's a pretty strong story, especially when it's, backed by the credit of, whatever bank it is. And we're only using the biggest banks, JP, Citi, Bank of America, Morgan Stanley, UBS, et cetera. And, again, those are the things that we want and we think advisors should be articulating and educating clients on, even if it takes a week or two or three. It's okay. These strategies, at least the way we educate, I think you can grasp it almost immediately, but it's okay. And, we just are worried that, more and more of the advice that we see that's given is just the traditional buy and hold. And when you hear of strategies like the energy strategy that reduces taxable income, well, people think, well, it's too good to be true. Well, no, it's not. Just Google the tax code. It's black and white right there in your face. Because you haven't invested in it before, because you haven't been shown it before, because nobody has articulated the pros, the cons of what that strategy is, doesn't mean it's too good to be true. Just like the banknotes. Many times people will tell us, well, why doesn't everybody invest in this after they are educated on it? And that's a great question. They used to require, at least the firms I was at, a significant either, generally it was net worth. It wasn't necessarily a capital commitment. And a lot of times it was, but now today, the minimums of these notes are only $1,000. And so they're really for everybody. And, the jobs of advisors is to always articulate and educate, what's out there. We don't want to ever be more of the same. Now, if we just did buy and hold, we would scale our business, I think, probably so much faster. What does that mean? That means right now you've made a lot of money. That means we've made a lot of money as well. But if the markets go down, that means you're probably going to lose money if you don't have any strategies that can hedge against, that downside. And I think that's a lost kind of philosophy because the markets have only gone really, we've had certainly drawdowns, no doubt about it, but the markets have just these unprecedented returns, which have been great, and I love them. And some advisors that manage risk can get tagged as, well, you can't outperform, you can't, outguess the market. Well, of course you can't. We don't think anybody can. Our crystal ball isn't better than your crystal ball, but we can include strategies like the banknotes that can provide you, a way to still, have, strong coupons that are being, sent to you as long as the markets aren't down 30%. Well, that might be something we want to look at allocating 10, 15, 20, 30% of your portfolio to, depending upon your goals, your objectives, your risk tolerance. Where do you want to be on a cash flow, standpoint and just kind of the overall mix? And, we can't stress enough, and we're really going to start talking a lot more about Bison Alpha, the hedge fund strategy that is our hedge fund. And you know what? There is a conflict of interest because it's ours, and it is our strategy. And but again, when you sign up with us and you look at sign our AUM, our asset management agreement, it says you have to actually initial that it's a conflict of interest because of because it's our fund. So to me, well, I don't know if I view it like that. I mean, I guess by the letter of the law, it's a conflict, but, we also have a ton of skin in the game. And, so those are the things that we think are important, but you need that flexibility. And when you look at, strategies that don't have to buy and hold, that don't have to only be long, where you only make the money when the market's going up, strategies that don't need to follow a specific asset class, strategies that can include, one of the things I love about our fund is we can take very small option investments that if they pay off, generally it's going to be meaningful to the fund performance. But if they expire worthless, it doesn't hit the performance on the downside much. And when you can kind of have this core and explore in a single portfolio, there's just a lot of torque. There's a lot of ways to manufacture strategies that can really deliver, and we love it. And again, it may not be 100% of never should be 100% of your portfolio, but can be 5, can be 10, can be 15, could be 20% of your portfolio. But the goal of an advisor is to really craft all of these unique different strategies and create something that if the markets do go against us, if the markets do go down, if we are in that period of prolonged market weakness, because let's face it, there is a lot of uncertainty. Uncertainty doesn't mean negative markets. It doesn't mean positive markets. There's just a ton of uncertainty. I think this is one of those periods in the markets that nobody really has an understanding. Well, at least the way I look at it, rather, is I could have a bull on one side that's super credentialed and tell me the markets are going to go to the moon. And I can have a bear on the other side who's super credentialed and tell me the markets are going to drop 20 to 30%. And you know what? I can think they're both right. And that's the challenge. Now, when we step back and we look back and we expand our time horizons, generally the markets are always up, but up in how much, can be debatable. And again, I love that statistic. You can do it on your own. If you bought Microsoft in 2000, it took you 14 years to get back to even. Purpose of explaining that to you is, yes, we're cherry picking that date because it was at the market high. And the markets went down, then they came back up, then we were hit by 08, and then ultimately it came back up. But where you are in your investment life, that can be very detrimental. That can be, add a tremendous amount of stress that maybe you don't want to have. So that's the importance of including strategies that, again, we believe have some sort of a predefined strategy. We want that. We want things like the banknotes. Double digits, currently with 30% downside protection. And again, not FDIC, not backed by the government, backed by the credit of the bank, which is why we're only using, banks that you and I would generally believe that they're the most, the strongest financial institutions in the world. And we do a lot of foreign banks as well. And, generally that's a lot of times their credit's actually better than the big domestic banks that you have heard of. And we look at the credit default swaps and everything. But again, hopefully you got something out of this radio show. Hopefully I made you think. I mean, that's my goal. My job every single radio show is to get you to think. And if we can help you out in any way, whether it's for 100% of your portfolio, whether it's for just a piece of your portfolio, we're open to having that conversation. So 630-492-1912, 630-492-1912. Make it a great week. We'll be back again next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.